Welcome to another episode of Two Gray Beards. In this episode, we have the honor of bringing Bob Elliott, a friend of mine from when we worked at Bridgewater together, to assess our synthesis and look at our portfolio. As an introduction, Bob spent a number of years, 15 or so years at Bridgewater out of college, working directly with Ray Dalio and running an important portion of the research team, as well as being assistant CIO. I don't know if the right term. He now runs a startup, Unlimited company, and that company has a portfolio of an ETF that Bob is the manager of that I'm sure we'll get into. Nick, hello. And what did you think about last week?
Hi, and it's an honor to have Bob here with us. I'm looking forward to his commentary. Well, what happened last week? I think it was another week of very low volatility. The bond markets are not really giving us any clue about which way they want to jump, or which way the yield curve wants to jump, and therefore give us an idea as to what equities will do next. Very quiet week, very little data. Most important data was the PMIs, which came back to show that the economy is really doing better than what most people think or fear. And therefore, equities did very little. I think the biggest theme that I keep on seeing in these markets is worry about the debt ceiling that's coming up in June, July, August, whatever the latest you know, ideas about from when it kicks in are. I would have thought July. We can all probably agree that July is the favored month for the debt ceiling to start being a problem. And therefore, what I am seeing, and it is a little bit worrying, is this continued switching out of US equities into foreign equities and a continued switching out of foreign bonds into US bonds. Because we all know that when the debt ceiling starts being a problem and people start worrying about a default in the US, which let's hope is never going to happen, what happens is that equities give up ground, US equities and US bonds do better. But there are still no signs of the ratio between bonds and equities being anything but in equilibrium still. Are
Right.
you seeing anything different?
Yeah, so the specific data, the PMIs at the end of the week surprised on the upside. That's after a month ago's PMIs surprised on the downside. And those are surveys. And surveys reflect the feelings of the people that are providing the answers to those surveys at the time they're taken. And a month ago, things looked bleak. We were in the tail end of beginnings of a banking crisis, and here we are, where that banking crisis seems to have been significantly relieved. That's one piece of data. The other piece of data, and this is very, very narrow and not something that most people pay a lot of attention to, it certainly is, you have to actually dig to find it, is that April 18th was tax day in the United States, and California's tax day turns out to be longer than it was. It is not April 18th because of a number of the most important counties getting a delay in when they actually deliver taxes. But what happens on tax day is taxes flow into the federal government, and now they have money they can spend. And so roughly, the checking account, which is called the TGA, of the federal government had gotten very, very low. I think it bottomed around $60 billion. And after April 18th, it's full again, up to around 280, 300 billion, roughly. Um, and that helps us in a very concrete way. And no one really knew until this happened when the money government's going to run out of money. Because if you roughly look at the spend rate, meaning when we run a daily deficit, meaning the government spends more than it gets in income every day, of roughly $3 billion a day. And so if you now extrapolate what we have in the checking account, remember, we can't issue any more debt in the United States because all the extraordinary measures of the debt ceiling have been used. You can divide the 300 billion we have by the 3 billion we spend, and place us somewhere roughly between 80 and 100 days, when you do the math closer, to when we run out of money. And that's the important time in which the forces, the House and the Senate, have to draft legislation to extend the debt ceiling or not. And so that places us roughly at July 9th to July 29th, roughly. And so I think we've narrowed the time when this debt ceiling crisis occurs. And I think that was relevant data and affected the markets in a way similar to what Nick was just saying. And in particular, has distorted the bills market, where bills that are definitely going to mature before that window are trading at very, very low yields, as everyone wants that form of savings. And bills that mature after that window are trading at a high yield, because no one who professionally manages money wants to own something that could default despite the extremely low risk. So, stepping back to last week, assets in general fell. Risk parity fell about 1.5%. 60/40 fell a little bit less because gold fell 3% and commodities fell 4%. Bonds, long-term bonds, fell about 2%. And short-term bonds fell about 1%, with the very short-term interest rates rising about 8 or 9 basis points. Equities rose 40 basis points in a very, very narrow volatility session. And so that's our synthesis about what happened last week. Bob, what do you think?
I think you've hit spot on the most important things going on, particularly around the debt ceiling and some of the various growth indicators that, at worst, imply a continued moderation in U.S. growth, but certainly nothing like the fears of an acute slowdown that some had predicted following SVB. And so each week we get the incremental information. We're getting incremental confirmation that we're probably more closer to back on track to that modest ongoing grind, weaker in the US, but still, close to potential, maybe a little bit above, maybe a little bit below. The only other place that I was looking at, that I'd highlight from last week's data that I think is interesting is, I think the UK continues to be an area to look at, to understand how the intersection between the tightening of monetary policy, economic conditions, and inflation are playing out. Now, each country's conditions are moderately different, but each one provides a nice laboratory. And I think what we're seeing in the UK is very interesting, that despite the tightening that's occurred, and despite an economy that's reasonably connected to the short rate in terms of repricing of debt, we're continuing to see inflation persist and have breadth and entrenchment across the economy. And that has got to be a warning sign across much of the developed world central banks about how difficult it may be to bring inflation down in a durable way. And so all that points to the combination of US growth being, continuing along moderately good, not great, but persisting, with that concern about inflation entrenchment, gets us back to closer to where we were earlier in the year before this SVB crisis, in quotes, emerged.
Thank you very much. Nick, you want to hit what we're looking at next week?
Very little data next week. And let's not forget that now we are in the Fed blackout period. So we are not going to get any more Fed speakers giving us any clues. Thank God. We have very little data now, apart from core PCE on inflation coming out on next Friday. We have durable goods and stuff like that, but very little that's going to influence the FOMC's opinion about what they're going to do on May the 2nd, May the 3rd, when they decide. It looks like 25% is fully discounted in the market, 25 basis points rather, is fully discounted in the market. And that is most probably what we're going to get. I don't know if any of you disagree about that, but I would have thought another 25 is on the cards. I think that we are definitely, just harking back to what Bob just said, we are definitely in a higher inflation environment that we were even a month ago. And bond prices are beginning to reflect that. And I think that as a result, I have absolutely no desire to buy any bonds at the moment. Although I do know what the market does in anticipation of a debt ceiling crisis. Bonds tend to rally, equities tend to fall. And I will post a very good summary of that by Goldman Sachs in the notes to this episode, so everybody can go and have a look at what tends historically to happen. It'd be interesting to know what you guys think is going to happen over the course of the next 6 weeks in the run up to the potential debt crisis, because I think the politics is likely to be very strained. I don't think either side is going to give in easily, and I think they actually are looking forward to a bloody fight.
Yeah, that's for sure. In past debt crises, what's a factual case is that the Senate and the House both have to pass the debt ceiling, and pretty much the Senate's willing and able. They can just pass a clean bill right now. And so it's going to be an interesting dynamic for the House, who doesn't want to pass a clean bill, wants to layer on a bunch of things that are consistent with their politics, and yet they also don't want to be completely tarred with the debt a debt default. So it'll be an interesting dynamic. I see no way they come together until July. There's just no reason for it. The crisis isn't imminent.
Which should mean that the market actually starts discounting the potential of a default. I
Right.
mean, it just gets worse until a minute to midnight.
Right. Bob, do you have a thought on that?
Yeah, I think you're exactly right. I think the basic dynamic of the debt ceiling is that if the U.S. reaches the debt ceiling, the consequence of that is almost almost certainly not a default on the debt. What it is it's a forced bringing of spending in line with income for the government with a fair amount of cushion. And that's because, receipts have to pay out expenses. And as Andy, you mentioned, the baseline is that the government's spending $3 billion more a day than they are earning on a day-to-day basis. And so you've got to create a relatively sizable instantaneous fiscal adjustment, right? In the same way, for those that are familiar with things like government shutdowns, this would be like a government shutdown only orders of magnitude worse. And so what that would create is a sizable growth shock, a downward growth shock that is, during the period where the spending by the government is cut. And like any growth shock, downside growth shock, you would expect bonds to rally on that news. And so as we see that pressure of the debt ceiling issue getting closer and closer to the date, we will see more and more of that downside pressure and growth being priced into the bond market. And so it's interesting because we're seeing this trade-off where actually the macroeconomic circumstances outside of the debt ceiling are probably continuing to push for higher yields, particularly after the adjustments that happened after SVB, whereas the debt ceiling is pushing down yields. And so there's going to be that interplay between the two. And so probably we're not going to see huge shifts in one direction or another until we either get a big shift in the macro data, which probably won't happen, or a debt ceiling resolution.
Right. And so now coming back to the very short term of next week, Bob, Nick mentioned the PCE. That's the last data they'll get before the FOMC meeting. The following week is very interesting. We'll come back to that in the next episode. But the shorter term is that we do have around $120 billion of twos, fives, and sevens being auctioned next week, this coming week, which should put some pressure on the front end of the curve to accommodate that supply. And that means yields higher. And one other thing, which, we don't have much to add, but earnings will also be coming, in particular, the end of the week and early next week during the Fed meeting, the big tech. And so, I expect those earnings to be more solid than most because I'm, with Bob thinking there's the growth in the economy is underestimated by most participants. But those are the things that I'm looking at. And also, just as another highlight, something that we pay a lot of attention to at my company, Damp Spring, along with the Federal Reserve meeting the week after next, there's also a lot of data that is particularly relevant to the debt ceiling crisis. And that is the government, the Treasury, announces two pieces of information that same week. They announce the amount of new issuance they're going to do first, and then the composition of new issuance. And second, in the middle of the Fed meeting. And what I expect is they will continue to favor issuance of long term bonds in a consistent and predictable manner. And because they are at the debt ceiling, they are going to have to reduce the amount of total debt to zero, essentially. And that will mean a significant reduction in the amount of bills they're able to issue during this coming quarter, which actually has been happening because they've been in the debt ceiling. So we'll be looking at that data, but more on that at our next episode. Bob, anything else that you're looking at this week particularly?
The only other thing I'd mention is the Bank of Japan has a monetary policy meeting, and it's UEDA's first policy meeting. Odds are they won't do anything, but I think it's important to recognize that the Bank of Japan and their policy shift. They've been the easiest central bank in the world for a long time, and to the extent that they start to see inflationary pressures, which we're starting to see emerge across the economy, the extent that you see a shift in their policy, that's another higher for longer impulse that could hit the economy on the global economy and global rates markets on the margin. So I'll be watching out for that. Probably no big changes, but it's certainly something to keep your eyes on.
Bob, on that point, my take on Japan is that while it is true that they've had the lowest interest rates, most negative, and the largest bond buying, certainly since QE ended, um, I think they need it.
Yeah,
Is there a fundamental reason that you think inflation will get out of control in Japan such that they'd want to withdraw that sort of stimulus?
I think it's more a question of the marginal shifts. I mean, if you think about where they are today relative to where they were when they implemented the policy, you've definitely seen an improvement, meaning inflation has risen. We're starting to see it flow through to core inflation, some signs in wages, some signs in areas outside of sort of imported commodities and looking at domestic services. And so you put all those things together, and I think the prudent move is probably some moderation in the magnitude of the easy monetary policy that they're implementing. Now, are they going to go to tighten 500 basis points, over the course of the next year? Probably not. But a shift, a continued, they would be another central bank shifting towards moderately tighter monetary policy than, frankly, is or could be priced into the markets given the nature of their existing policies. And so that's the answer is they still need easy monetary policy, but less easy than when the policy that they're running right now was implemented.
Fair enough. So at this stage, we go through our portfolio, Bob. We'll start with some ideas for where we're heading, and then hopefully you can assess where we are. Nick, what do you think about the portfolio at this stage? You said you don't want to buy bonds. I'm with you on that, but there will be a time when, at least for a tactical reason, we'll want to add bonds.
Yeah, I think it's probably going to be next month, if at all. But at the moment, looking at what tends to happen in the run up to a potential debt crisis, debt limit crisis, we all know historically what has happened. Bonds have rallied, as I said, equities have gone down, but the major beneficiaries have been the Swiss franc and the Japanese yen, the typical flight to safety instruments. And we are quite low on equities. We're at around 24%. in equities simply because we don't like equities at this price. We think they are, expensive. So I was thinking, should we buy something like a Swiss uh, stock market ETF? And I've been looking at EWL, which is composed very heavily of Nestle and Novartis. That's about 40% of the EWL ETF, but it's in dollars and therefore should benefit because the Swiss franc appreciates much more than I think it'll appreciate because Nestle will appreciate or Novartis will. What do you think of that idea?
Yeah, so I'm a little cautious. So I like it. Let's start with that. But I'm a little cautious on the rapid move in European equities and the level of the US dollar. Um, and, this idea that in 2011, equities fell 20% leading up to the debt crisis. The Swiss franc rallied a lot, the yen rallied a lot, US bonds rallied a lot. Versus
Equities
today,
fell a lot.
yeah, equities fell 20%.
Yeah.
Um, was wrapped up in it was over a year of Greek bond crisis. I was at Bridgewater at the time, and in fact joined 3 days before the flash crash, which was really the beginning time of the European debt crisis. So a year later, things got worse, and this happened. So I'm wondering if the market has already front run the effect of a debt ceiling. But I think when you look at it and you see what we've just described as the next, call it 2 months, 6 weeks of not looking good as it relates to the debt ceiling resolution, there's a possibility that we get some continued flight to those types of assets that have done well. And I prefer that to, say, buying nominal bonds here in the United States, expecting them to do well in a debt crisis. I prefer owning equities. I prefer owning non-dollar equities, and Swiss franc makes the most sense to me. Certainly not yen because of the issues we've just described. Though that may be good for the yen, it probably wouldn't be good for Japanese equities. So yeah, I like the idea. What do you think about size allocation? Did you mention?
Something like 4 or 5%, and I wouldn't chase it. I'd buy
Yeah.
1% now, at market on Monday, and then have lower levels, just hoping to get filled, and then wait because we are still many many weeks away from this debt crisis. So I don't think chasing is really called for right at the
Okay, you'll
moment.
discuss that in your single
I
section.
will do, yes, but I'm more interested to know what Bob thinks about it.
Well, I think Andy's right in giving the right historical context about what was going on, particularly around European asset prices that had challenges, including the support to the Swiss franc at a time when also the U.S. was having a debt ceiling issue, and so we might not want to draw too acutely parallels between the two circumstances then to today. The thing that comes to my mind as you discuss this is gold priced in dollars, which to the extent that we have a circumstance where first we see bond yields rallying in the event that the debt ceiling becomes like a more acute issue, that's beneficial to gold. And then secondarily, of course, gold sits as a typically as a tail risk hedge, a broad tail risk hedge to inflation and macroeconomic and political tail risks. And so, maybe gold is an interesting play here. I know you have some in your portfolio, but when I look at your risky assets and I look at the balance between the risk that you're taking in, say, equities versus the risk that you're taking in gold, you've got considerably more risk in global equities, by several multiples than you do in something like gold priced in dollars. So it may be a time to look to that as a complement to the portfolio.
So instead of EWL, i.e., the Swiss equities, which are not, I mean, Nestle, very safe. You're talking about Novartis, also very safe, non-volatile as a stock, low beta. You'd prefer to add to the gold allocation.
Yeah, I think that's probably going to be if you don't want to hold the bonds as a hedge, which I think a prudent perspective on it. Then if you're looking to really create that sort of hedge on a tail risk, gold is a good option in terms of how it's playing out, and we've seen gold over the course of the last year be very resilient relative to what you would expect, how you expect gold would have played out given the rise in interest rates. And so I think it's really showing itself as that hedge to tailed outcomes, right? Whether it's war or political circumstances or the dollar, or in this case, it may be the debt ceiling. So that would be probably where I would go.
So I hear you. We have what we consider an overweight gold relative to our portfolio. I get what you're saying relative to balance. We own no nominal bonds, and we own um, a fair share of equities. Not a lot, as we said. Our minimum is 20%. What we do own is a lot of cash, and a
Mm.
lot of cash-like stuff that is inflation protected. Um, and so as I think about the risk of the portfolio, I guess it's possible to overweight gold a little bit more. I hear that. I'm just wondering if the large cash allocation and the large short-term tips allocation sort of offsets that sort of overweight gold issue.
Well, I think the main question is how are tips, cash certainly. I mean, if you take a step back in terms of the overall portfolio, uh, you're obviously running at pretty low risk relative to what you would expect on a historical norm with
Yeah.
that significant cash allocation. Which, to be clear, I think is I'm very aligned with that. From our perspective, we look at the most sophisticated investors in the world and how they're running their books. They're running at very low VAR today, basically at 20-year lows. And the fact that your book is running basically at very low risk, I think is highly aligned with that. So really, what we're talking about is sort of on the margin, exactly how do you position to balance for these circumstances. And I think probably there's an from my perspective, there's an underappreciation of how bad the tail risk could be, and in particular, when you start to get to less liquid instruments, tips, as you know, during acute circumstances can often trade in a way that's inconsistent than what you'd expect because of liquidity reasons. So that may be a place, where you might you might be concerned if we really get a pretty bad outcome. You might have some issues with liquidity in those instruments, and so that's why I like pairing the tips with the gold, to make sure that you're getting enough protection through that sort of environment. But overall, the idea of this is a time to run at low risk. The yield penalty for cash, which typically is high, today is actually,
Very low.
cash is the best yielding asset out there
Yeah.
today, right? And so, on a risk adjusted basis, certainly. And so
So,
you're
so
you're
you're
not paying a big price to hold cash.
So your synthesis would be, given what we've discussed and given that we're broadly aligned, is less equities, less tips, more gold,
Yeah,
but
that would
but already pretty damn low risk.
right, exactly. We're talking some about on the margin here rather than, a big picture disagreement, because the big picture is this is not the time to take big bets on one particular outcome or another. There's a lot of uncertainty. The debt ceiling just adds another complexity in terms of the uncertainty. Not a time to take a lot of risk. And so the overall portfolio, I think, is well positioned along that along that.
Bob, what do you think of our portfolio balance overall?
I think that the biggest thing when I looked at the portfolio is just recognizing how much cash you're holding in the portfolio, how low of risk overall you're taking in this environment, and uh, I think that's very prudent. Is the short story. There's um, as you get to a later cycle environment, a later cycle tightening environment, assets typically underperform. It's typically not a great time to be holding assets, and so being significantly overweight cash makes a lot of sense. I think in addition, when we look at, typically as an investor, cash has a significant yield penalty in one form or another. It's certainly been the case for the last 15 years, and today's circumstances are very different. So in many ways, by holding a significant amount of cash, not only do you get to earn significant yield, but you also get that option value, right? That future option value to invest in assets as prices change and opportunities become available. And so when I look at the overall composition of the portfolio, the amount of cash that you have might look extreme, but I think it's very prudent given the uncertainties that exist in the market today and where we are in the macroeconomic cycle.
And at the margin, just to repeat. Perfect. Thank you so much for being here. I think we've gone 10 minutes over our normal time, but I think it was well worth it. Thanks again, Bob, and we look forward to talking to you on Twitter and hopefully sometime in the future again on this program.
Yeah, thanks so much for having me. It was really fun.
Thanks, Bob. Been great fun and very instructive. Thank you.
Nick, you'll do your segment.
And as a result of that lovely discussion with Bob, let's have a look at the portfolio and what we have finally decided to put in as orders for next week. As you can see, our allocations are unchanged because nothing was done last week. No orders were filled. The chart pack I have updated with EWL and also Africa, which is starting to become interesting and will be the topic of a future episode with levels that might be interesting. Certainly, foreign markets are definitely more interesting than the US at the moment. I've updated the broker statement. You can download it from here. And the order entry for next week actually is quite interesting. Nothing was done in VWOB, XLV and XLE. Those bids still stand. But as a result of the discussion with Bob, what we've decided to do is buy 50 shares of EWL at market on Monday, and then buy 60 shares at each of these levels, so at 47, at 46.50 and 46. So if the market comes back, because you will see from the chart of EWL how much it's gone up in the past couple of weeks, and we really don't want to chase it very much. But what we'll be doing is also leaving a bid for GLD at 182.10, because that is a very important level, I think. And if the market trades there, we probably want to add to GLD. And as Bob says, that's probably just as good as, if not better than, buying EWL. So for good or worse, that is what we're doing. We're having a bit of a ramp up in positioning as a result of the possibility of the market starting to discount a problem with the debt ceiling, which won't come till July, but that does not stop the market from anticipating it. Finally, what I've done is here in resources, in research and resources, I've added this picture that you might have seen on the screen of what the effects of a debt ceiling battle are on the market and how much risk off is driven the last time we had one back in 2013. Thank you very much indeed, and have a wonderful week.